All right, let's talk about a revolution that happened right under our noses, one that completely flipped the world of business upside down. It forced thousands of companies to change, literally, how they report their own financial health. And believe me, this isn't just a story about boring numbers. It's a story about hidden debt, huge corporate scandals, and how a brand new multi-billion-dollar industry was born almost overnight. Let's get into it. $2 trillion. I mean, just look at that number. This is what was keeping regulators up at night. It's a massive, almost unimaginable financial obligation held by the world's biggest companies that was, until just a few years ago, pretty much invisible to investors, to the market, to pretty much everyone. The financial watchdogs had a name for it: the $2 trillion off-balance sheet obligation. And here's the crazy part. This wasn't some illegal back-alley scheme. No, this was a perfectly legal loophole in the accounting rules that let companies look way healthier and a lot less in debt than they actually were. So the $2 trillion question is, where was it all hiding? I mean, how could that much money and commitments just vanish from the official books? Well, the answer is in what might be the most deceptively boring topic you can imagine: lease accounting. Yeah, I know. But trust me on this one, the story of how this secret was kept and how it was finally dragged out into the open is anything but dull. And this wasn't just some technicality for accountants to argue about. This lack of transparency caused real-world damage. It helped fuel massive scandals like Enron and created these huge unseen pockets of risk that played a role in the 2008 financial crisis. Because at the end of the day, if you can't see a company's real debt, you can't possibly know its real risk. So to get how this worked, we've got to look at the old rules, a standard called ASC 840. For decades, these rules let companies play this kind of financial shell game, making enormous debts disappear from the single most important report they publish, the balance sheet. The magic trick was something called an operating lease. Under the old rules, a company could lease, say, a whole fleet of airplanes for 15 years, a deal committing them to billions in future payments. But they could structure it as an operating lease, so those payments just looked like a simple rent expense. And the multi-billion-dollar long-term debt? Poof, it never, ever hit the balance sheet. It was, for all intents and purposes, invisible. And this shows you just how dramatic the change was. In the old world, under ASC 840, those operating leases were hidden away. The balance sheet looked artificially clean. But in the new world of ASC 842, bam! Pretty much every single lease longer than a year has to go on the balance sheet. It's a complete shift from hiding debt to showing the true picture. This whole shift was driven by new global standards, ASC 842 here in the US, and a sister rule called IFRS 16 for the rest of the world. After the financial crisis, regulators finally said enough is enough, and they dropped this bombshell on the corporate world, forcing what everyone started calling the Great Recalculation. The mission behind it all was beautifully simple, really. Just bring all of that hidden debt out of the dark and into the bright, harsh light of day. No more games, no more hiding. So how'd they do it? Well, first, companies now have to calculate a lease liability. Basically, this is the total value of all the future payments they're on the hook for, and that number gets slapped right onto the balance sheet as a new debt. This is the part that says, here's what we owe. But of course, in accounting, for every action, there's an equal and opposite reaction. So to balance out that new debt, companies get to record a new asset. It's called a right-of-use asset. And this represents what the company gets for all that debt, the right to actually use that building or that fleet of trucks for the entire lease. Now, the whole thing is built on a financial concept called present value. It's actually a pretty simple idea. Money today is worth more than money you're promised tomorrow. So a promise to pay 10 grand in 5 years isn't a $10,000 liability right now. It's something less. And that complex math is at the very heart of these new rules. So the theory was simple, right? Just put all the leases on the books. But the reality? Oh, it was absolute chaos. These new rules were so complicated, they got a nickname in accounting departments everywhere. They were these spreadsheet breakers. So why did spreadsheets just break? Well, for starters, every single lease, even for the office copier, suddenly needed its own crazy multi-year math schedule. You had version control nightmares leading to failed audits. A single typo in one fragile formula could blow up the entire calculation for the whole company. And trying to manually stitch together, say, 500 of these things for your official reports, it became literally impossible. But the headache didn't stop there. The new rules also forced a distinction in how you classify leases, and this little detail has a huge impact on one of the most important numbers that Wall Street and executives obsess over, EBITDA. It's a key measure of a company's core profitability. Okay, now this is where it gets really interesting for the CFOs. Look at this. For a finance lease, the costs get split into interest and amortization. And since EBITDA, by definition, ignores those two things, it makes your profit look higher. But for an operating lease, it's just one single expense that directly reduces your EBITDA. The takeaway? Since executive bonuses are often tied to that EBITDA number, how you classify a lease suddenly became a very, very big deal. So what do you get when you mix total chaos, mind-bending complexity, and a high-stakes impact on profits? You get a massive problem that needs a real solution, and that creates a massive, multi-billion-dollar opportunity. And just like that, an entire software industry was born out of thin air at lightning speed. Suddenly, you had all these new companies pop up. You had market leaders like FinQuery, which was built by accountants who actually lived the nightmare. You had established players like Visual Lease, AI-powered challengers like Trulian that could read the contracts for you, and even the big accounting firms like Deloitte and PwC jumped in with their own software. All of them built to solve the one problem that finally broke the spreadsheet. But you know what? The story doesn't end there. Now that all this critical data is finally in one place, organized and digitized, this boring old compliance software is starting to transform into something much more powerful, thanks to AI and a whole new set of global pressures. The next big step is what people are calling agentic AI. So instead of just being a fancy calculator, these systems are becoming strategic advisors. Imagine a CFO just typing a question in plain English, like, hey, what's the total financial hit if we close all of our European stores next year? And getting an instant, sophisticated answer. That's where we're headed. So think about what's been created here. For the first time ever, companies have a perfect, audited, centralized database of every single building, vehicle, and piece of equipment they use anywhere in the world. And that exact same data that's needed for financial rules, well, it could soon be the very engine that calculates a company's carbon footprint. With new ESG regulations coming online, these platforms are perfectly positioned to be the single source of truth, not just for finance, but for sustainability too. And just like that, a story that started with $2 trillion of hidden debt might just end up being a critical tool for building a more transparent and a more sustainable future.